Hi everyone, welcome to the Timing Research Show for August 3rd, 2015. My name is David Kosmeter. I'm the creator of Timing Research, and if you have not had a chance to take a look at this week's report yet, just go to TimingResearch.com/reports, and you can download last night's report or any past reports there. Today we will be talking about the 97th weekly report from Timing Research. And I have Dave Landry guest hosting for me again this week, so I'm going to go ahead and turn it over to him.
Thank you, Dave Kosmeter, and thank you to TimingResearch.com for having me back once again. We've got a couple of veterans this week, and why don't we start with you, Ken? Ken, tell us a little bit about your trading, and tell us a little bit about PacificAcademy.com for those of us who don't know you.
Well, my name is Ken W. Chow, and my trading is based mostly on chart patterns, more specifically what I call trend strength. And trend strength basically is a way to read price structure on a simple bar chart and determine how strong the trend is, either up or down. If the trend is going down, you figure, great, I can see it going down, but is it accelerating to the downside or decelerating to the downside? That makes a big difference, whether you want to buy on a dip or do you want to go with it and remain short. And I'm a mentor with Pacific Trading Academy. What we do is we actually have different types of programs to teach people how to trade better. And we have several mentors, and depending on your style of trading, Pacific Trading Academy would match you up with the different kinds of education that you would need. Again, my particular specialty is using Fibonacci ratios, okay, but more importantly, using them on proper price structures and patterns.
Cool. All right, Matt, let's go to you. Matt's also known as his call sign, the Wiz, or just Wiz, I guess. Matt's with Top Gun Options. Tell us a little bit about yourself. Well, where are you now? You ever stay home?
No, Dave. Home is on the road, man. I'm actually coming in from the options capital of the world. I'm up here in Chi-Town. I'm up in Chicago.
Cool.
Yeah. So up here in Chicago, I gave a speech over the weekend to JBS, one of the largest food processing companies in the world. So,
cool.
But yeah, Top Gun Options, as the name implies, and as Dave just said, is based on some military methodologies. I flew the F-18 Hornet for about 15 years for the Navy. I graduated from the Navy Fighter Weapons School, which many of you know as Top Gun, and also flew 44 combat sorties over Iraq. But for about 3-4 years.
God bless you.
Thanks, man. About 4 blocks from where I am right now, I ran Peak 6 Investments, which was, when I was running it, about a $2.5 billion volatility arbitrage firm, which it's worth a hell of a lot more than that right now. And we also built a retail brokerage firm called Options House, and I ran the Options News Network. So we used to shoot on the floor of the CBO and the CBOT, a bunch of shows, and showed people behind the scenes activity in what's going on. And we'll talk about that as we get going, Dave.
Okay.
But literally was in the VIX pit on Friday and sent out a trade alert, getting very, very bullish. A tactic called a bullish double vertical on VIX on Friday. I sent out to my my folks, and look at the VIX today as we implode. So and I still think that's a good trade today to get long vol going into September. But so Top Gun Option, we use charting, we use fundamentals, we use vols, you name it. To steal a military analogy, if you look at one of those radar plane, an AWACS, right? Looks like a big UFO landed on top of a 707. That's kind of how I trade. I take everything into account. Don't focus on one individual area. Because I like to develop what I call situational awareness. You have to know about politics because politics drives the markets. I mean, who would have thought, when Vladimir Putin would invaded, first of all, where the hell is Crimea a year and a half ago, and why is my portfolio down 10 grand right now? Well, you need to know about stuff like that. So we kind of take that holistic approach at Top Gun Options. So that's a little bit about me and what we do.
Cool. What pit were you in? I forget. Were you in the options pit? CBOE?
Well, we were off the floor, so we Peak 6 traded off the floor. We traded equity options, so you need everything. Stayed away from biotech, man. We did not trade any.
Yeah, it's fun to be short vol there, huh?
Yeah, that's exactly right.
Okay, I'm Dave at DaveLandry.com. For those of you looking to get in touch with me, my website is obviously DaveLandry.com. I believe in using price only to predict price, and also I believe you can only predict short term when it comes to markets. You could stick with positions longer term if they move in your favor, but the reality is you really can only predict short term. Now, that doesn't mean you can predict the short term every day in all markets all the time, but if you have a setup based on trend or emerging trend, and most of my methodology, or pretty much all of my methodology, is pullback related. Anyway, so you can predict the short term if you have the correct setup and good stock selection. Coming in today, we don't have any new stocks. We just sit on our portfolio and wait for some new setups. And sometimes you just have to wait it out. And I talked a lot about that today in my column. But anyway, I have a 21-page report which explains the methodology, and the rest is just details. You can get that on my website. If you go to products under free reports, it's there. Ken, let's go back to you, and we'll elaborate on this question in a few minutes. But first, let's get your prediction. Based on any technical or fundamental indicators you want to use, would you predict the S&P 500 index will move higher or lower by the close this week, and that's the close of Friday, August 7th. And then once you give us your prediction, go ahead and rate that on a confidence scale of 0 to 10, with 0 being no confidence and 10 being extremely confident. And if you remember from the last show, or last show you were on, 0 is actually a 50-50, means it can go either way, and 10 would be 100% sure. So you?
Well, it's pretty choppy if you look at the daily chart of the S&P, and I would really hate to stick my neck out for something even 5 days from now. I agree with you that only short term could be more clearer in terms of seeing what is more predictable than something even 5 days down the road based on what I see on the daily chart. If I were to stick my neck out, I would think it'll be going a little bit higher, okay?
Okay.
But the confidence is somewhere around 4 or 5.
Okay.
It's just too far. It can chop either way based on how they're going to predict this week's economic news, employment reports and jobs reports. All these other things may whip it around. So I'm not going to think that far. So I really don't have much confidence in any prediction that I can make based on my charts right now.
Okay. Yeah, I mean, it's been chopping around for ever since last Thanksgiving, so
yeah.
It's kind of tough to predict. Matt, let's go to you. Matt, you guys have been enjoying this. We've had range with volatility, something I haven't seen in years, and that's you option guys are probably having a blast with that. You guys having fun with that?
Oh yeah, well it's been like shooting fish in a barrel. I tell my traders I didn't want any of the China or Greek crisis to end, because trading weekly options, these weeks have been phenomenal. A Monday, Tuesday, rip your face off rally has been followed by a peter out Wednesday, give some back Thursday, selling to close Friday, and then today we see the implosion. Will bottom out a little bit tomorrow, flat Wednesday. And I think we're unched by Friday, and I'm what's that, a 7 or I'm 8? I'm probably around an 8 that we're unched. We make a round trip. We had some weak macro out of the gate with some Greek and China issues, but as Ken said, by jobs on Friday, I think we make a round trip to unched. To be honest with you.
Did you? But you gave us a prediction though, right? Did you say up or down or forget? I know you said unched, but
I think 0 is unched, right? If we're flat, I think we're unched 0, and then I'd say an 8 as far as confidence level. That's what
You have to give us up. You have to give us up or down. How about like up and 0?
After what we're doing this morning, I'd say, like Ken said, a little bias to the upside, just because of the Leviathan known as central banking. But yeah, a little up, but mainly unched. Unched, slightly up.
Gotcha. I hadn't played with those weekly options much, but I'd be willing to bet that I spent about 15 years on an options firm as a principal. So I'd be willing to bet you've got tremendous gamma situation going on there.
Oh, absolutely.
Is that correct? Yeah, cool.
Oh, yeah.
Yeah, I remember many years ago, I wish expiration was every day, because that'd be a lot of fun. All right, I'm going to go ahead and predict higher, and with not much confidence. I'll give myself a confidence of, I don't know, about a 4. And I'm just going to continue to err on the side of longer-term trend. Again, we haven't done anything since last Thanksgiving. at least in the S&P 500, and well, the Nasdaq's still kind of sideways too. One thing that I found kind of interesting is we've stayed above the 200-day moving average for a long time. And if you have daylight above the moving average, and not just, you can't just follow this mechanically because it will chew you up and the market's a little choppy. But as a general statement, if you look for daylight, meaning that the lows are greater than the moving average, and I'll flesh it out when we get to the next question, flesh this out when we do the next question. But as a general statement, once the market is trending, you could just use that to stick with the trend longer term. And we've only had a few days of daylight over the last couple of years, and the market's going up tremendously since then. Now the moving average is catching up to the index, so it'll get kind of interesting really soon. Not that that's a line in the sand, but again, I'll flesh this out when we get to the next question. Ken, let's go to you. Speaking of the next question, and next question is, if I can find it. I know it from heart, though. What developing events that can be technical or fundamental will you be watching out for this week, which ends obviously on August 7th for us traders, that might have a positive or negative impact on S&P 500 and other U.S. markets?
Well, there's always the jobs reports and other fundamental news that would come out around 10 a.m. East Coast time. But I tell you, I don't really try to predict what those things will be. Okay, I like to have them come out, and then react to see if they're going to whip it up and then bring it down, or vice versa, as a way to gauge what the patterns will form after those things hit the fan.
So it's not the news, but the reactions to the news.
Exactly, how they react to the news, and then how other players would react to the news. More like a counterpunch fighter than somebody who's going to stick his neck out, because they can, with all respect to what Matt and other guys who can assimilate a lot of information, fundamental news, and all these other things, my brain cannot take in and process so many different pieces of data to determine how the big boys, will react to something that would hit the fan. I mean, it can be interpreted either way depending on which direction they want to weigh it more heavily. And I'm not going to make that prediction to predict how the big boys would react, versus I want to see how they would react and then see what the chart patterns would show to see whether subsequent market moves will confirm with that initial direction or the counter direction, following that thing, that the news that would hit the fan. So I'm more of a I'll be aware of when those important things would hit, but I'm not gonna play to them. So,
gotcha.
Yeah.
So you can tell Ken must actually trade, because he spoke a lot of hitting the fan. Quick question, Ken. What's your I'm just curious. What's your time frame as far as are you a day trader or your position trader, or where do you position yourself?
Myself?
Yeah.
Oh yeah, day trader. I'm a
day trader. Okay.
Day trader, holding period for half an hour, maybe 2 hours.
Okay.
And that's it. I close my positions at the end of the day.
Okay. Cool. All right, Wiz, let's go to you. What developing events, technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, it's let me bring my screen up here. Can you guys see my screen now?
Yeah, we can.
Okay, good. Well, as Ken said, it's obviously jobs. Well, here's the way I take. First of all, Ken's right. There's a lot of complexity in the market, but as a naval aviator, how do you, flying in combat or off an aircraft carrier is difficult enough. So how do you battle complexity with simplicity? That's why flying an airplane, I need to be able to walk and chew gum at the same time. So,
yeah.
Flying upside down, talking on the radio, selecting a missile, looking at my fuel, doing 50 things at one time, I'm absolutely comfortable with. And being able to make a very, very close to informed decision in the blink of an eye after taking in all that data is, it's not a skill you're born with, obviously. I wasn't hatched like that. It was, drilled into my head. But I think we're in a no man's land here. If you look at the S&P 500, the moving we smashed through the 50-day this morning, and we've been, every time we've tested this 200. I think we head down to this 200-day moving average on the S&P 500, and we get another bounce off of it. placing a trade before a jobs report or something like that could be seen as throwing a dart, and you could wait until to see how the market reacts to it, but you have to give that some time, to be honest with you. I mean, how many times have we seen a jobs report in bizarro market?
Yeah.
And I call it bizarro market because in bizarro market, good news is good news, duh. Bad news is good news, huh?
Yeah.
And then awful news is just phenomenal news.
Yeah.
Why? Because awful news under Bernac meant, well, game on, let me keep the spigot open at 85 billion a month. Now it means, interest, Mama Fed, Ms. Yellen's going to sit on her hands a little bit if we have awful news. So, because everybody knows, I have a lot of wizisms that people can write down, but when interest rates are high, stocks will die. Interest rates are low, stocks are going to grow. So, you can start to see that, with the Fed meeting last week. Let's debrief a little bit of last week. That she said, hey, and all her lieutenants more or less have been running out the microphone, giving vertical head nods, like, September is okay or pretty realistic if we see some good stuff. So if we see a good number on Friday, which hold on, I forget, senior moment here. What are we calling for on Friday? Non-farm payroll, 224. So we got 223 last month down here, as you can see. We're looking for 224. I think a beat, the market goes down. And inline, same thing. And I think, and we'll talk about the VIX eventually, Dave, when we get to it, but I think anything other than an absolute implosion, if we have one of those, what was it, like 3-4 months ago, like an 88 print, everybody looked at each other like, oh my God, what the hell is that? Are they missing a digit? Unless we get one of those, I think we start going into some, what we used to call taper tantrums, right? Before Bernac was going to taper, the market would kick and scream and pull our hair out if he was going to taper. I think we're going to start.
I remember that was 2 years ago. I had a buddy of mine. He's a trader from Italy, Emilio Tomasini, and he was here. And I was at the house, and he was staying over here in my office, and then he came in and goes, "What does taper mean?" And I'm like, "Oh crap!" I come into the office and everything was just going south, and so I'll never forget that taper tantrum. I love it. I love it.
Yeah, toilet taper.
Matt, why don't you, while we have you, go ahead and let's go ahead and pull the VIX up and work that into your this question, unless you want to save it for the last question as far as indicators.
No, go ahead.
All right, go ahead, pull it up. That'd be cool. We got time.
Yeah, so what we're looking at here, and I just gave you one of those wizisms about interest rates. Here's another wizism, and just confirm, you guys can see my screen right now, my trading screen, right?
Yeah, we can.
Okay, good. Write this one down, okay? When vol is cheap, you buy it. When vol is expensive, you sell it. So, and the VIX, folks, when you're talking about vol, and like I said, I was on the floor Friday in the VIX pit. The VIX is a mean reverting instrument. What's that mean? A lot of means in there. It's like me on a treadmill, at a 10 incline at 10 miles an hour. I can do that for about a little bit, and then I got to get back down to quote, what's my resting heart rate? The resting heart rate recently of the VIX has been about a 12. And then you can see, about a month ago, there's the absolute freak mode because of China and Greece imploding. Here's another little freak mode here. So the trade that I put out the other day, and look at the VIX up. I mean, this is a rip your. There was a 12. I tell my traders, if you see a 1 and a 2, meaning $12 or an $11 in front of that decimal point, it's hurricane insurance, folks. When I live down there in South Florida, and you buy hurricane insurance when it ain't hurricane season. When there's a hurricane coming, you can get it, but it's going to cost you a lot of money. So that's why when vol is cheap, you buy it, and then as it spikes up here, you sell it. 12% rally in the VIX today, and I think we still got a ways to go. Here's the trade that I sent out on Friday. Not that I'm Nostradamus, but with a 12 print on the VIX around Friday, there was a lot of people looking around going, don't pay no attention to me. I'm just going to go over here and get long vol because, and this is a bullish double vertical out to September, okay? My strategic mindset is, and just like you were talking about, Dave, and I show this chart often of May/June-ish of 2013. and the VIX went from 12, where it was Friday, up to 22 or 25-ish. And I asked people, looking at that chart of the VIX, that spiked from 12 to 20, it went up 100% in a couple weeks.
Yeah.
Was the market going up, down, or sideways? And 90% of the people say, well, the market had to go down with the VIX. I'm like, you're wrong. That was one of those, market was going up on, 85 billion a month, but that was one of the meetings where the Bernanke was expected to announce the start of the taper. So remember, folks, that the VIX can go up on, as market up, VIX up, something's up. So when the market was going up and the VIX was going up, and of course the VIX is like a balloon. So as soon as Bernanke came to the microphone and said, "No, things are cool for now. We're not going to taper," the VIX went from 25 back down to what? Its resting heart rate of 12. So what I sent out to my traders on Friday was, we sold a bull put spread, a 13.5, 12.5, and bought and used that. That's called a credit spread. I took that credit and I bought a bull call spread. This is called a bullish double vertical, and I got it for a credit. So somebody, the market is paying me to be long vol going into the uncertainty of the September Fed meeting. That's a stupid trade. That's one of those things where I'm just like, this is a duh trade. Institutional traders,
the so-called money in the corner, Jimmy Rogers trade, walk over to the cup, huh?
That's exactly right. As everybody knows, the market's going to be a little freaky going into a September Fed meeting, so why wouldn't you get long vol? The market can still melt up, but I'm telling you, man, but before she goes out to the microphone, my dad, bless his heart, he used to get me to the airport, 3 hours before my flight type of guy. I'm like, Dad, or he's like, hey, man, I'm not that important enough for them to, if I'm 1 minute late. So with a VIX trade, before she even walks out to the microphone that Wednesday, I'm going to close it, because even if she raises rates coming out of her mouth or doesn't do anything, that's certainty. So once something is known, it's not what? Unknown to Chatham Rumsfeld. So bullish double vertical going into September on the VIX, bearish roll inverted and do a bearish double vertical. So even with the VIX, go ahead.
You got a lot of moving parts in that trade, and you and I take a different approach. I used to do a lot of VIX work many years ago, and I've published a few systems there, but I'm no longer trading the VIX outright. I do take a peek at it every now and then, but other than outright options, I'm not doing a lot of spreads or anything anymore. So I'm just curious, what's your worst case with that? Because you got a lot of moving parts in that trade.
The worst case to the downside, and it's fine. Well, I closed my screen, but the worst case to the downside is, I think it's a lot. I think I have 50 or 150 contracts. If the VIX pops above 17, that trade makes like 16 grand. If the VIX implodes to below that bottom strike, I think was the 12.5, I think it might lose 3. So you're risking 3 to potentially make 16. And I got to tell you, if the VIX drops below 12 going into that September Fed meeting, where we might see the first interest rate rise since 2004, that means Jesus, Buddha, and Muhammad all came back to life, and peace, love, and understanding is broken out. Slim the none possibility of that, and Slim just left town. That ain't happening. Period.
I haven't heard that in a while. Yeah, good stuff. A lot of moving parts. I keep things a little more simple, but that's very interesting, and I totally like where you're coming from with that whole thing. As far as, what was the question? What developing events? I'm a technical trader, so let me see if I can get my screen shared here for everyone. And we were talking about the S&P 500, and the next question is, what indicators do you use? And I'm going to answer it quickly. Other than the occasional moving average, I don't use any indicators. I'm going to elaborate on that in just 1 second. But the daylight thing that I was talking about is when you have the lows are greater than the moving average, and if you back the chart way out, you can see that this has happened for a long, long time. In fact, you could actually draw a trend line between the moving average and the lows. Now, you don't want to rush out and trade this in and of itself, but just keeping things simple and watching this daylight, once you have an established trend, will do a really good job of keeping you in the market. And one thing that I've learned throughout the years is obviously everything works better with trend. And I'm a trend guy, obviously. And I've seen people get up and speak in person where they'll have a market that goes from A to B up 100 or 200%, and they'll have like 20 or 30 buy and sell signals, and they're showing you their system. And in reality, if they would have just bought when the trend was established and then used something as simple as a moving average, they could have, instead of having 100 or whatever it was buy and sell signals, they could have just held on and rid the trend the entire time. Now, it's not always quite that easy, but you're much better off following something simple when the market is trending than to trying to outsmart the market. And so far, so good as a 200-day moving average is concerned, the overall market. And I'll elaborate on some of these things in 1 second. Let's go to the question of the week. Ken, let's go back to you. And the question this week, let me just make sure I get it right, is what technical or fundamental indicators are most influential for your trading or investing?
Well, the most important thing is just price action, pure price action. And let me see if I can get my screen up, and if you guys can see that. Can you guys see my screen?
Now we see you so far. Oh, there it is.
Okay. Now, as far as I'm concerned, I'll go by simple price action. A downtrend looks like this. An uptrend looks like this. Can you guys see that?
Yes.
I think there might be a little delay. Yeah.
Oh, okay. Well, to me, let's take a look at a downtrend, for example. And there are two types of downtrend. This is a downtrend because you have a lower high and a lower low. It's a simple zigzag. Well, here's another downtrend. Okay. Now, the one to the right seems to be showing more trend strength to the downside than the one to the left. I'm using a simple bar chart, and the reason why is that the one to the left have this big up bounce, which is a retracement against the downtrend, a pretty deep up bounce. Okay, that's called the bulls trying to put their 2 cents in this downtrend. The diagram to the right, the bulls are not doing a good job at pushing it against the trend because this is what I call a shallow bounce before new lows are made. Okay, does that make sense, Dave? It's a very simple type of chart pattern. Now, if you layer this type of situation on top of each other, and again, it goes into a lot more details than this. This is what drives the first of all, the direction, in this case down, and more importantly, the strength of the trend. What you're looking at here is the crude oil chart, and in late November, December of last year, notice how these bounces are shallow. Okay, shallow meaning less than 50% or about 50%, and then you get a new low. It bounces less than 50%, boom, new lows. It bounces less than 50%, boom, new lows. This is called a downtrend. Then we have consolidation. Now we have this downtrend again, starting with this little mini high here in early May. Downtrend, lower highs, lower lows. Now what is this? This is a very shallow bounce. Again, this is a daily chart on crude oil, and once you clear this low here, coming off of a shallow bounce, let's call that point C. Okay, I'll call that point A and then point B. Now point C is a bounce in this zigzag pattern. Okay, and what is the zigzag pattern? It's a downtrend based on what they call the measured move, lower highs, lower lows, and we go down to find point D. Now, this bounce from B to C is the counter trend bounce before a new low gets made. Now, how deep is this counter trend bounce? Is it this deep before a drop, or is it just a little bit? Well, in this case, it's a little bit. In this case, below B, right around there, is where you have to say, watch out below. Okay, and now you have another layer of that. This is getting kind of small, but here in purple, also what I call a shallow bounce before new lows are made on this daily chart of crude oil. What that tells me is that the downtrend is not only intact, but it is strong, deep retracements. Now you contrast that with, let's take a look at some other market, and S&P. The S&P, if I can switch over right now, you can see how for the most part, we have deep retracements in both directions. Here's an uptrend. Here's a deep retracement, meaning this uptrend here does not have a lot of trend strength to follow through to the upside. Instead, it goes down. On this downtrend, it bounces pretty deep. It's called a deep retracement. You can eyeball this and say, well, it's a sideways market. Yeah, true. But in particular, specifically, what you have is a deep retracement. The bulls are pushing it up almost to how far the bears pushed it down from this high over here. Okay, so based on that, it's purely a sideways market on this daily chart of the S&P. So I can't really stick my neck out and say what's going to happen. But once we see something like this, and I'm going to show you what I'm looking for. If we have something that comes down here and goes up on what I call a shallow retracement, and then we loop around downwards from here, the moment it takes out this low here, I think it's going to continue on further downward moves if we have shallow bounces on this downward lower highs, lower lows series of patterns. This is what I look at in terms of chart patterns. I don't use any indicators. I hardly use moving averages. It's just based on these type of chart patterns. Of course, I would use Fibonacci ratios to determine the distance of where it would move and what it means to be shallow and deep in terms of these bounces against the trend. Again, in this case, assuming the downtrend will be established. And by definition, a downtrend is simply a lower high and lower low, as I've shown from that ABCD pattern. So that's all I'm using on a daily chart, on a 5-minute chart, even down to the 1-minute chart to tell me where that sweet spot is, where I can get in, get out. And in this case, if I have something like this showing, you can go on a breakout trade below here to follow through, and I'm hoping to ride out a pivot that is also shallow. That means I can hold on to the trade because the downtrend is not only intact, but is still moving down pretty strong. Likewise to the upside. So to answer your question, Dave, it's simple chart patterns. How deep, how shallow. That's all it is. The deeper the retracement, the more sideways-ish and the more weaker the trend is, either up or down. And that's what we have for the whole 6-7 months in 2015 for the S&P. Whereas in contrast to that, other markets, again, like crude oil in late last year, you can see the shallow bounces and quick downward burst, shallow bounces, and so forth.
Yeah.
So that's basically all I do.
Cool. All right, Wiz, I'm gonna throw something out at you a little bit. I don't know if it's setting you up or not, but I sense that you're a mean reversion trader. One of the problems that I see with some mean reversion traders is that they trade mean reversion in markets that don't mean revert, and then they also, on the flip side, they try to pick out trending patterns in something like the VIX. So do you see that? I'm guessing you're a mean reversion trader mostly, and let me just throw it to you, see what you have to say about that.
Yeah, not mostly. I mean, like I said, it's more of a holistic view to trading. You have to look at that though, because whether it's the VIX or some other indicators, think of a salad bowl and you put a orange right at the end of it and roll it in. Yeah, it's going to move around, but it's going to end up right in the middle of the bowl eventually. So, but I got to be honest with you, some technical trading or mean reversion, like you pointed out, Dave, it can be completely counter-cyclical to the way they're thinking. I look at sometimes looking at the left side of a chart as driving around the Daytona 500 looking in the rearview mirror. So nobody can tell you with certainty what the right side of a chart looks like, but by trading options.
And if you find a broker that lets you trade at the left side, let me know.
Yeah, that's exactly right. That's awesome. I love that. That's a great point. Nobody trades off the left side of the chart. But at least with the options market, we can use a tactic called the at-the-money straddle, where we can actually look forward, whether it's August, September. You can pick a point in the future and look at that expiration, and the options market is actually going to tell you with some degree of probability, hey, I think, let's just Apple or take whatever you want, the S&P 500 or Apple, that it's going to trade in this range, and we have a 60-70% confidence of that. What's that mean? there's a 30% chance that ain't happening. Of course, one of those missiles can always reach out and touch you. So, mean reversion, all that type of stuff. It's on my AWACS, so to speak. It's got a couple seats in the back of my airplane, but not super, because I don't know how many times you do look at that and it's like, well, that didn't do what it was supposed to do, and you kind of leave your head scratching.
Yeah. Well, in the VIX it works pretty good, but in other markets that have a lot more black swan events, for lack of something better to leave a term there.
Well, correct.
Yeah. In true mean reversion, you don't use stops, or you shouldn't use stops, and that, like I often say, that'll work until it don't. But yeah, I respect what you're doing there with the VIX, because that makes a lot of sense.
Correct.
I mean, cut you off.
No. The VIX volatility is a mean reverting instrument. Like I said, you can't run on that treadmill 10 incline, 10 miles an hour forever. And going back to that chart of the VIX, over the past 10 years, and I was in the STIBO when it hit 80 or 90 in 2008 or whenever that day was. I remember that. It's a 20. Right now, that resting heart rate, like I've showed you for the past couple of years, has been a 12. So we should, quote unquote, that's an example of it not working. We should be, if we're looking at that left side of the chart, the mean is about a 20, and we're down here at, even with the spike today up to 13, there's an example of it not working. But then let's kind of reset the mean down to that resting heart rate at 12. Yeah. I got to tell you, man, if you see an 11 or a 12 in front of that decimal point at the VIX in this type of environment, with China imploding, with the Greek clown car and the Fed coming, and just corporate earnings that are like, you gotta get long vol. And then if bull is going to come back too, so that'll be just around the corner. So correct, absolutely. And then as I showed you on the VIX, with any one of those little freakouts, oh my God, there goes the Shanghai and the Kospi or the Nikkei, and we get a big spike in the VIX. Guess what? People ain't going to freak. Once you go buy hurricane insurance, you don't get it again or a third time or a fourth time. People already got it. So once that event passes, then go ahead and then sell it.
Yeah, I hear you. As far as the way I trade in indicators, it's such. I don't use any indicators other than the occasional moving average. By the way, Wes, one thing that I've discovered with the VIX, I saw some absolute level systems years ago where it said, oh, you buy when it's below 15 or you sell when it's above 15, and that worked until everything changed. Like you said, the heart rate. I like that. It changes. So what I figured out is that you just use a moving average to let you know what that heart rate is, and then you wait for it to stretch from there.
Correct.
But I don't do too much of that anymore. I've kind of boiled everything down to its utmost essence and in trend guide. And if you look at my website up here, I have the up arrow, the down arrow, and the sideways arrow. And just by chance, in today's column, this is the back of my business card here. I have an uptrend, downtrend, and a sideways trend, which is a lot of people don't realize sometimes the market just goes sideways, and you got to be really careful when it's doing that and be real selective. Like I said earlier today, we only have one setup coming into today. Now, I don't know if I can share this real quick. Let me try to share this other screen. I believe that you could, again, you can only predict the short term when it comes to the markets, but you could stick with the trend as long as it moves in your favor. So if we can try to come up with an example or two. If you take a look at like Fitbit, for instance, this is a good example of what I like to do. We actually had a setup back here, and then we had a secondary setup recently in here, and so far so good, knock on wood. But I like these more volatile issues. I also like IPOs too, which tend to be more volatile. But I compensate for the volatility by trading fewer shares. And I'm a trend trader, and I trade in the direction of the trend. For instance, this is one we're actually long, and you say, well, it's gone sideways in here. Well, so what? We've already taken partial profits. And way back here, we had a nice little trend. We had a little pullback, and we got long right in here. We caught a nice little pop out. We took partial profits. And now we're just going to ride that position as long as it moves in our favor. And this is the actual I put these indices in here so that'd be easy to use. But this is the actual long portfolio right now. We are 100% long as far as those three longs. We did get stopped out of a short recently at a profit overall. But again, I'm looking for the pullback. I'm looking to take that short-term profit and then trail a stop higher on the remainder. So hopefully I'm with that position a long time from now. And I believe that you need to err on the side of the trend. That's why when I do these shows, as long as the market stays above the moving average, not that that's a line in the sand, but it's an easy way to say, okay, well, the trend is still up, and there's no need to get super bullish as long as it's going sideways, but as long as we stay above the moving average, because predicting the market, unless you have some sort of setup, is a crapshoot at best. But what I've been doing in these shows is, as long as this market's been above the moving average, I've been bullish, and we're not that far away from new highs in here. Now, obviously, I like to see them sooner rather than later. Now, Ken brought up a lot of good points. If we do drop below, let's just say 2050 or the 200-day moving average, which is not that far away from there, then you're going to have a lot of overhead resistance. And like Ken said, I think, I don't know if he mentioned this outright, but I think anyone who bought in this area might be looking to get out at break even if the market stays below that resistance for a while. And that's just human nature. Everything I do has a psychological basis to it. So I know that a lot of people probably bought in this range, and then it's just human nature that they can look to get out at break even if we drop below it and rise back above it. So the main thing, let me just share one more screen here, and then we'll go ahead and wrap things up. But I want to show you today in the column I wrote, and it just kind of dovetails in nicely with this today's deal. Let me see if I can get this to share real quick. A lot of people, and I don't know if it's sharing properly yet. Oh, there it is. Basically, today's column was that if you're smart, congratulations. Unfortunately, I have some bad news for you, because you tend to fight trends and you try to see things when there's not anything there. And the main thing I pointed out is that I get a lot of charts from a lot of smart people who claim to be trend followers, and the chart looks like an electrocardiogram. So I wrote today, what's that beeping noise? So if a chart looks like this, it's obviously not a trend. So at least make sure that you have some sort of trend, or at least an emerging trend, before you look to trade. If you are a trend follower, you consider yourself a trend follower. One thing that I wanted to point out, I like the way that earlier Wiz said that, and then Ken might have said it too, it says there is a chance you could be wrong, and something bad could always happen. And we brace for that as traders, and I think a lot of novice traders, I don't want to get too far into trading psychology, but I think that a lot of novice traders think that because we are professional, this is what we do, that we have all the answers, that we always know where the market is headed. Well, if we do that, we own the world, obviously, and we don't. So that's why the money management is vitally important. And again, the money management can also help you with the psychology. I don't want to get too far in that because I'm going to be a little off topic. But the bottom line is you can only predict the short term when it comes to markets. And if you have a nice trend in place, I like to trade pullbacks. And someone pointed out to me a while back that I'm actually, even though I say I'm not a reversion to the mean trader, I am in the sense that the pullback, when it goes back up in the direction of the longer-term uptrend, is a reversion to the mean trade. So I'm trading that for a swing trade, and then I'm sticking around a lot longer. Now, I don't need to go on much. I don't have to go on much further on this because it's all. I have a report, like I said, on the website. Check that out at Landry.com. Ken, let's go back to you. Any closing thoughts on anything we said today, or any closing thoughts you want to tell us about your trading, the markets, or TradingAcademy.com? Floor's open to you, Ken.
Well, like I said, I try to simplify my trading over the years. I used to be enamored with all these fancy indicators about 10, 12, 15 years ago when electronic trading came on board, and it was just information overload. Okay.
Yeah.
And throughout all of that, the majority of them don't work because they're all lagging. And what we try to do, a lot of retail traders, unlike Matt and a lot of big-time professionals who are working for big firms with billions of dollars, we try to kind of find out what really what we can handle. Let's put it that way. And what I've come across, what I came down to was basically just looking at simple chart patterns and just the deeps and shallows. What that is telling us is a deep off of the high, but shallows off the lows. What does that mean? Think about it. Or vice versa. If it's shallows off the highs, but deeps off the lows, you kind of know that the market is sort of leaning in one direction. Even though it's going up, it may be topping out, as opposed to even though it's going up, it's going to keep on going up. Right? There's a big difference in terms of how these deeps and shallows lined up. And what I try to do is trying to impart that in the most simplest and obvious ways to some students who sign up for my type of who like my type of thinking. Okay, so through Pacific Trading Academy, what they do is they basically communicate that to the marketplace and see what type of students are out there who may jive, who want to learn more about this way of approach to trading. And I have a comprehensive way of looking at chart patterns. For example, the butterfly chart pattern, not the butterfly option strategy that I'm sure Matt is very familiar with, but it's a butterfly chart pattern along with Gartley's and other things.
Like a Gartley,
these patterns are very powerful, but when you add in the component of trend strength, meaning in that pattern, do we see some shallows off of this direction and deeps off of the other direction? That can improve the reliability of these patterns tremendously. So that's where I'm at in terms of what I do for myself and for the students who like to sign up for this approach to trading, which is basically chart reading, chart pattern recognition. And these are simple chart patterns once you learn to identify the deeps and shallows. And that's all it is.
Yeah, I like what you said about the Holy Grail hunt. I do a webcast every now and then where I draw like an arrow where you start up here with the simple, and then you go through this big complex thing, and then you end up back where you started, and that's when the true enlightenment tends to come after you go. But it seems like everybody has to go on that indicator hunt. You could show people how to do things, and they'll look at that, and then they'll go off. And as soon as it stops working for a little while, they'll rush off and try to do something else. And then those who seem to be successful come back about 10 years later, and those are my favorite clients.
Let me say one more thing. I think in my personal experience, price is the only truth. I'm sorry, but if you can take that and squeeze different indicators out of it, that can give you some sort of idea to have you lean in one direction. But if you're especially a short-term trader like myself, I like to see many layers of, shall we say, shallows in one direction on a 10-minute chart versus a 60-minute chart. If they're all shallows, say shallow bounces on the way down, I'm going to be thinking about entering to go short a little bit more, to ride out the move a little bit more. So price action is really what is that, because anything derived from price action is 1 degree away from the truth.
Right. Yeah, and when you make a trade, you're not agreeing on the fundamentals or the earnings or the situation in Nigeria or whatever the case is. You're agreeing on price, and amen. You know, why do you need that second and third derivative when it's right in front of you all along? Now, one thing I like to point out is that sometimes, and this is why I do occasionally use the moving average, sometimes, especially like when I'll use like 3 moving averages, which I call my bow tie moving averages, when you have a possible change in trend. Sometimes a moving average or whatever other indicator you use, and I don't use any other ones, but it might help to illustrate. I call them more illustrators than I call them indicators, because it might help to illustrate what's already in the chart, but the chart is still there. I've seen some really good guys who use a lot of indicators, and I'll say, well, don't you have a signal here? And it's like, well, I don't like the chart. So it's like, I think they sometimes some of the more successful ones with indicators tend to hide behind their indicators, but deep down, I think they're still good chart readers. Wiz, let's go to you. Any closing thoughts about anything we talked about so far today, or anything else you want to tell us about TopGunOptions.com? Floor is yours.
Yeah, you bet, man. The first of all, what you were talking about with some trading psychology, folks, for all the retail traders out there, this, don't fall out of your chair. Professional traders want to win, I'd say, on average, at least a lot of the firms, 60% of the time. Now, for all the retail traders who just fell out of the chair and who want to win on every trade, that's why you're probably not doing well. I think I haven't pulled it in the past.
I'd be happy with 60%.
I was just going to say, we're up at about 70-ish at Top Gun Options, but and for the folks who don't understand the math behind that, over time, even if you're winning 51% of the time, folks, on your trades, over time, you are crushing it. So, you know, a 60% win rate over time. If you're looking for quick strikes and everything, I mean, we trade weekly options here at Top Gun Options. We can talk about that. But so, talking about trading psychology, if you're trying to hit it out of the park on every plate appearance, man, you might put a couple out of the park, but you're going to get hit in the face a couple times or strike out a hell of a lot more often than not. So know those losses can occur. You guys were talking about price. You had me all until about this point. Here's and look at this this headline here. Where is it? On I think it's BBC. China stock traders count his losses. Quote: never trust the government. So, price, you guys are right. You know, China looks for scapegoats in continued stock market decline. Well, it's official. Foreign speculators are to blame. So, price in true capitalism, in true markets, should be efficient. The problem for the past couple years is price isn't necessarily efficient when you have a central bank involved. I mean, hell, for a while there, the Bank of Japan was literally buying ETFs and ordering Japan's largest pension funds to buy China.
Yeah, but Wiz, you're not necessarily using that to predict the market. You're using that to help you with your volatility and whether or not you want to be long volatility or short volatility, correct?
Well, yes and no. I am using it to predict the market a little bit in this respect. I made that word up. In this respect.
It's yours now.
Yes, exactly. In this respect, in that this is going to end horrifically. It's going to make 2008 look pleasant. That's what I'm getting at is when, not if, notice the two words there, when the Federal Reserve starts raising interest rates, we are going to freak the hell out. I don't care how earnings are looking and, you know, consumer confidence and this, and you can throw all the indicators in the world. Once the Fed starts to try and back out of capital, and one of the reasons the Chinese markets imploded this time last week, 8.5% last Monday, was the fact that the Chinese government tried to see if the little bird could fly out of the nest on its own, and it did, and flew straight into the ground. So price can be efficient if it's allowed to be efficient. Parting thought, man. This is craziness right here, folks. Apple has smashed through its 200-day moving average. So Apple's officially in a correction right now, down 12% from its post-earnings high there. We're at 6-month lows, and I love the bottom at Zero Hedge here. It says paging Carl Icahn. Expect a tweet here pretty soon out of Carl Icahn to say, it's undervalued. And I am getting ready to, in a couple minutes, once we get off here, I'm going to send out a trade alert, bullish double vertical out to about October on Apple, using a bunch of different reasons. First of all, if you're a pure technical trader looking at that, all right, man, Wiz, I don't want to catch a falling knife, quack, quack, quack. I get all that stuff. Every fall, folks, you can set your watch to it or your calendar or your sundial. Apple does what? Hey, join us October 2nd for a they email some reporters with a cool invitation. They know about Christmas, Kwanzaa, holidays, winter solstice, whatever the hell it is you celebrate. It is a no-brainer right now with Apple down this low. If Apple doesn't hold here and goes lower, I'll pound the hell out of it into the dirt and get bearish. But right now, folks, knowing the fall cycle and how Apple tends to rise into the holiday season and then give some of that back, waiting for that Q1 or Q4 earnings, I should say, this would be my parting thought here, man. That's not catching a falling knife. Apple ain't going to zero, folks. If it does, get your AR-15 and join me up in the mountains in Montana. We got a lot bad going on. So that would be my parting thought. If you're interested in what we do here at Top Gun Options, you can go to our homepage there. But if you want to maybe get an urgent alert on that Apple trade, or even take a look at the VIX trade that I kind of reviewed a little bit, you can go to topgunoptions.com/urgent-alerts, or you can just go to the Top Gun Options homepage there and hover over the services drop down. If the Hilton internet would work good, hover over the services, because I know some people are like, well, I'm a quick strike tactical trader, and I like trading weekly options. Well, we do that. We do accelerated retirement, where services, TopGunOptions.com services. Accelerated retirement, for example, it's up 43% that portfolio year to date, but it's a little bit more conservative. So yeah, stop on by. We'd love to have you, man. So David and Dave, thanks for having me, bro.
Cool.
I appreciate it, and look forward to coming back.
Glad to have you back. I do weekly webcasts, as some of you may know. If not, check out the countdowns on my website. They have the upcoming webinars and appearances, both in person and over the web. Each week we have a pretty good time. I don't take myself too seriously. I don't know if you guys have picked up from the show or not, but you know we can be wrong, and we just keep it simple and try to keep it a little bit light while covering, which can sometimes be a bit of a boring subject. But any questions that you want answered, if I don't answer you personally, I'll use it as fodder for the weekly webcast, and we'd love to have you there. Bring your favorite stock picks. We'll take a look at them from a trend-following perspective. Now, if you show me something that looks like an electrocardiogram, then I'm probably not interested, and I'll beat you up a little bit if you plan to be a trend trader, or you intend to be a trend trader. I do a nightly webinar once every several weeks, every 2-3 weeks, sometimes a little bit longer, depending on what topic I'm covering at the time. It could be stock selection or IPOs. I'll probably do one on IPOs coming up again, since I'm going to be redoing an IPO course fairly soon. But again, just trend follower. I think you can only predict short term when it comes to markets. Keep it simple, and then maybe dabble in some of those other things. But get the basics down first before moving into that more complex stuff, instead of doing just the opposite. Anyway, I think that's good for this week. Great guest again this week. This was, again, a good show. Ken and Wiz, thanks for being here, and I'll let David wrap it up and give you guys one more mention. So thank you guys for showing up. I appreciate that. And once again, David, thanks for having me back. It takes your time and research. He might have dropped out. I'll go ahead and close the show up then. He might have had an internet connection or something happen. Ken, we have Ken Chow. There he is. Hey, Dave, you want to wrap it up, or you want me to go ahead and close things up?
Yeah, of course, my browser crashed right before, as soon as I needed to talk again. But yeah, thanks, guys. Great show. Just want to remind everyone to go to TimingResearch.com/reports, and you can download any of the recent reports there. Also, just want to thank my guests, Ken W. Chow of PacificTradingAcademy.com and Matthew Buckley of TopGunOptions.com. Also, of course, Dave Landry of DaveLandry.com. Thank you for hosting again, and thanks, guys, for being back. And just want to remind everyone to come back next week and see you in the next week's show.
Thank you.
So, thanks. Bye.